After last week's central bank blitz, this time around investors will be looking at the issue which is consuming policymakers, namely inflation. The latest figures for the UK will be released by the Office for National Statistics, or ONS, on Wednesday the 22nd of June. These figures will cover the month of May. Now for April, the Consumer Price Index, or CPI, reached 9%, the highest mark since this reading's inception in 1997. The CPIH index, which includes housing costs and is the Bank of England's preferred measure, that rose 7.8% year on year, and the Retail Price Index, or RPI, that rose by 11.1% year on year. While RPI is no longer an officially recognised statistic, it does offer the longest dataset in the ONS archives. The last time RPI hit this level was February 1982, and the Bank of England base rate was almost 14% back then, absolutely miles and miles and miles ahead of where we are today. Central bankers, politicians, investors, economists, and the British public will benchmark the May inflation figures against the wage growth numbers of Tuesday the 14th of June. They'll also perhaps add the unemployment rate released on the same day to the inflation rate to get an update of the so-called misery index, an indicator created by economist Arthur Ockham. The latest misery index score for February, when we last had the two numbers together, that stood at 9.9, the highest in September 2013. But with inflation galloping higher, that number is likely to rise to levels not seen for over a decade. This may in turn explain why the UK GfK Consumer Confidence Indicator languishes at a record low. The reading for April was -40, and the next score is due out on Friday the 24th of June, so keep an eye out for that, as economists at the OECD, CBI, IMF and other members of the alphabet soup are becoming progressively more gloomy about the UK's economic prospects. Now, annual general meetings may dominate the corporate news flow of the UK in the coming week, although they themselves are often accompanied by a trading update. First half or full year results or analyst meetings are also due from or at the following, although some of these dates could yet be subject to change. Primark owner Associated British Foods and S3 on Monday the 20th of June. Telecom Plus and Safestore on the 21st. High-end house builder Barclay, Micro Focus, ProCook, CVS and Grainger on the 22nd. Serco, Naked Wines and Marlowe on the 23rd. And Harworth and Carnival will cover land and sea to end the week on Friday the 24th. But the company which could be the biggest cause of a fuss in the week ahead might just be DS Smith. The packaging giant is set to release its full year results to the end of April on Tuesday the 21st of June. The shares are down by a third over the past year, and they now change hands at levels last seen in autumn 2020. Worries which appear to be weighing on the shares include weakness in packaging volumes, as the online shopping boom perhaps cools post-pandemic, and shoppers cut purchases of consumer goods even in supermarkets as times get tougher. Investors are also keeping an eye on rising input costs and the degree to which DS Smith can protect its margins with a combination of price increases and cost efficiencies. Investors will look to Chief Executive Officer Miles Roberts for some answers here, and also to how the full year results stack up relative to the guidance given alongside April's trading update, where DS Smith gave 4 steers as to what the figures could look like. Note that investors will also look for any guidance in the fiscal year to April 2023 on the basis of all of these, in addition to the actual results for fiscal 2022. First, the firm flagged like-for-like corrugated box volume growth of at least 5%. Second, DS Smith stated volume growth and price increases had more than offset input cost inflation, to imply margins had held out. Third, the company pointed toward adjusted operating profit for fiscal 2022 of £605 to £610 million. That implied an adjusted operating margin of 8.9% compared to 8.4% a year ago. Analyst consensus forecast suggests that equates to a stated pre-tax profit of £375 million against £296 million last year. For the new year just begun, the consensus is seeking further growth in stated pre-tax profit to around £495 million. Finally, DS Smith targeted further reduction in net debt. Borrowings piled up after the 2018 acquisition of Europac, even allowing for the fundraising that accompanied it, and DS Smith has started to reduce those liabilities. At the first half stage, net debt had come down to £1.8 billion, including leases and pensions. Note that the stated profits figure will feature a £30 million write-down relating to the company's withdrawal from a minority investment in Ukraine, which had chipped in £4 million of after-tax profit in 2021. Investors' attentions will then turn to the dividend. Like so many firms, DS Smith cut its shareholder distribution in 2020 owing to the pandemic, but it increased the payment by a fifth at the first half stage of this year to 4.8p a share, and analysts are looking for a final dividend of 10.2p. That compares to 8.1 a year ago, will take the total payment for fiscal 2022 to 15 pence compared to 12.1 in 2021 and nothing in 2020. For the coming year, analysts have penciled in a dividend of around 16 pence a share. Finally, shareholders and analysts will look for any updates on the company's medium-term goals, which are organic volume growth of at least GDP growth plus 1%, an adjusted operating margin of 10 to 12%, and free cash conversion of more than 100%. It'll be interesting to see if management feels it can stick with them, or whether it feels global events make them just that little bit harder to achieve. Thank you for watching. I hope that you and your families are all in good health and good spirits, and I look forward to seeing you next time.